Hello and welcome to our Business Management Unit 7. We're talking about business finance in this unit. Today's lesson is lesson 7.2. It is on forecasting when it comes to business finance. So our objectives for this lesson are to define forecasting and explain how businesses may use it to predict future cash flow, to explain operating income and provide examples of operating expenses, and to calculate the operating income for a sample company. So when it comes to forecasting, this is using past and current data to predict future cash flow for a business. Businesses rely on forecasting models for a variety of reasons. It's used for allocating funds for budgets such as hiring employees, research and development, also known as R&D, marketing, operating expenses, and wage increases. Also helps to plan for future expenses such as business expansion, economic downturns, and pandemics. Now, there are different kinds of forecasting methods, and you can kind of see in this little diagram right here some of the various types of sales forecasting methods. But we're going to look specifically at calculating operating income. So step one is total revenue, is determining your total revenue. You do this by multiplying the volume, which is the number of units of goods sold, by the unit price to determine the total revenue received from the sale of the product. Next step is figuring out your production costs. This is where you multiply the average unit cost by the volume to determine the cost to produce the units. Now, the average unit cost to produce the product is the total cost of production divided by the number of units produced. Step 3 is your gross margin. This is where you subtract total production costs from the total revenue. And then finally, step 4 is subtracting the operating expenses from the gross margin to determine the operating income. Now, operating expenses, we're going to touch back on that just a little bit, sorry, but the operating expenses are the expenses that occur due to normal business operations. So let's take a look at an example of calculating operating income, okay? So let's say we have these numbers, okay? We've got our volume at 4,000 units, our unit price at $30, our average unit cost of $10, and our operating expenses at $7,000. So step 1 is your total revenue. You multiply the volume by the unit price. So this is 4,000 times 30 equals 120,000. Step 2 is your total production cost. You multiply the average unit cost by the volume. So 4,000 times 10,000 equals 40,000. Step 3 is your gross margin. You subtract your total production costs from your total revenue. So 120,000 minus 40,000, that's 80,000. Finally, step 4 is determining your operating income. This is where you subtract the operating expenses from the gross margin. So in this case, 80,000 minus 7,000 is equal to 73,000, and that's how you get your operating income. So this was our lesson 7.2, where our objectives were to define forecasting and to explain how businesses may use it to predict future cash flow, to explain operating income and provide examples of operating expenses, and to calculate operating income for a sample company.